Hello friends, welcome once again. I'm Krishan Sharma and I'm here to discuss with you an interesting topic of investments, which is time and returns. There is a lot of confusion between short term and long term. I travel so often and everywhere we debate the definition of short term and long term. We will definitely discuss on this point, but more importantly, we will deliberate on what type of investments you all do. Some investments are good for short term, some for medium term, and some are better for long term. Equity mutual funds. Equity mutual funds are an amazing mode of investment. I have seen in my life that even small investments of rupees 2,000 per month, rupees 3,000 per month, if invested systematically, can sum up to a crore over a period of time. But do you know that only 2% people are successful in doing that? This is very disappointing. There is a splendid tale of mutual funds across the world, and perhaps the best part of it is the fact that they have delivered excellent returns for its investors. However, the worst chapter of this story is that mutual funds delivered good returns, but investors unfortunately could not earn these returns. Such is the sorry state of affairs of investors, and we have to ponder upon it. What is the reason for the same? It is because investors don't complete their journey. They constantly convert long-term investments into short-term. Let us try and understand why time is important and not timing. What is the relationship between time and returns? Let us see how this relationship works. Let me give you a technical reason. Pardon me for using jargons, as I won't be able to explain this concept to you in simple language. How are share prices determined? We will not be able to understand how returns are generated till the time we don't understand how share prices are determined. Let us understand this with the help of an illustration. Prices are established in market with the help of a very ordinary process, and that process involves the rate of return of our investment. Let us assume you have 100 rupees and you invest 100 rupees in bank FD. This FD gives you an interest rate of 6%. So what does this mean? You made a payment of rupees 100, price or payment, and for this payment of rupees 100, you are getting an earning of rupees 6. Alright, if you pay rupees 100 to the bank, then the bank will give you rupees 6. If you divide 100 by 6, that is 16. For every 16 rupees, bank will give you 1 rupee interest. And this is called price-earnings ratio. Now this example was of FD. Bank decides the rate of interest for FD. You and bank don't decide the rate of interest mutually. Bank decides the interest rate. Let us face another situation. I have a good quality cow which gives good quality milk, say about 10 liters per day. I want to sell this cow. Now at what rate will you buy it for? So this is a very interesting topic. Cow is the product over here which is to be sold. Its price is to be determined. For the price you pay, you also get a return. For FD, the return was 6%. What is the return for this cow? 10 liters of milk every day. Now what is 10 liters of milk supposed to be? It is earnings. There are about 100 people present here, and let us assume all of you desire to buy this cow. And I ask each one of you individually to quote the rate of this cow. Now, because I cannot determine the price of this cow alone, we have to mutually determine the rate of this cow. We will negotiate the rate. As a result of this negotiation, there will be an interesting outcome. One person will quote rupees 5,000, another one will say 6,000, someone will say 10,000, 11,000 and so on. Why is that so? Because you can see the cow, and by observing, some might feel it is old, some might say it's young, some will say it's overweight and some will say it's underweight. Some might like or dislike its color. Some might have limited knowledge about cow's health and its life. There are so many dimensions to it. Is there a scientific process in the world to determine the best cow to buy, which has the right color, right age, right weight, etc.? Unfortunately, there isn't. Then how will you decide it? You do the assessment yourself. What factors affect your assessment? The biggest factor is your state of mind. If you are in a happy state, you quote a higher price. And if you are sad, you quote a lower rate. Your state of mind determines it. We also call it as sentiment. Now, what does sentiment imply? Let us assume that the cost of 10 liters of milk is rupees 100 in the market. So, how much is the financial earning? Rupees 100. One person offers me to sell the cow at rupees 1,000. So, what is the price in this case? Price rupees 1000, and earnings rupees 100. We got 16 as the price earnings ratio for FD. Similarly, how much will it be in this case? It would be 10 here. Another person is ready to buy it for rupees 2000, but earnings is still rupees 100. He feels that the cost of milk will rise in the future. The cow is still young and has a long life to live. There is no similar cow in the town which gives 10 liters milk every day. That's why this is one of the best cows according to him. This is his assessment. Hence, he is offering me rupees 2000 instead of rupees 1000. When he is ready to pay rupees 2000, payment is 2000, earnings rupees 100, PE equals 20. So what does the price earnings ratio indicate? It indicates the sentiment. It indicates your state of mind. The first person's sentiment is weak, and the second person's sentiment is very strong. So whenever market sentiments are good, the prices will be higher. When the sentiments are weak, the prices also tend to be lower. So what is the equation to decide the price of the share in the market and how it is decided? Price of the share is nothing but earnings multiplied by sentiments. Sentiment is reflected by PE ratio. This is the equation of market discovery of the prices. Market returns are nothing but investment returns. These are called earnings plus speculative returns. We call it speculative because everyone has different estimates. Speculative returns are called PE ratio. Investment returns are called earnings growth. Earnings growth is dependent on the country's progress and development. Sentiment depends on the news flows in the country and also on the inflation. I hope you have understood the technical part. If you want to understand about stocks, then this much effort is definitely required. Now let us see how price discovery is done with the help of earnings and sentiment. I will show you a backtesting result. Backtesting means the outcome of the markets in the past. We have 4 investors with us. The first one invests in Nifty. He invests daily in the Nifty as soon as it opens. But he remains invested only for 1 year. He invests just only for 1 year. He sells it off as soon as it completes 1 year. The second investor also invests in the same Nifty. Nothing changes for him. He too invests daily as soon as the market opens and at the same price as the first one. But he decides to change one variable, that is period of holding. He decides to hold the investments not for 1 year but 5 years. He sells his investments after 5 years. Same way there is a third investor. He does not take any efforts to do research and invest in Nifty as soon as the markets open at the very same price as his predecessors. But he also changes the holding period. He prefers to hold it for not just 1 year, not just 5 years, but to hold it for 10 years. Similarly, the fourth and the fifth investor too did their investments in the same way and decided to hold their investments for 15 and 20 years respectively. It means the first investor sells his investments after completion of 1 year, while the fifth one after 20 years. What are the common elements? They invest daily in Nifty with no research and at the same prices. Let us see the experience of the first investor. Remember, this is backtesting of last 20 years. Here is the outcome of the first investor. He has invested in Nifty 50 shares through Nifty. He invested every single day since 1st January 1994. When did the 1 year term get over? 1st January 1995. That's when he sold it off. Similarly, investment of 2nd January 94 on 2nd January 95. 3rd January 94 on 3rd January 95 and so on. So I believe you're getting my point. What exactly he did? This pattern of investing over the last 20 years resulted in these returns. What did you observe, friends? These are his profits on every investment and these are his losses. What pattern are you observing in this picture? The best part of this slide is that the probabilities of profits are more than the probabilities of losses. These are investments in equity mutual fund, or you can call it as index mutual fund. Nifty 50 is the index and you observe that the probabilities of profits are much higher than that of the losses over a period of 20 years. This is the peculiarity of this slide. What is the scary part of this slide? Observe carefully, friends. The most worrisome thing about this slide is that there are possibilities of losses. There are instances of losses on investment in this market. Perhaps the worst thing about it is the high volatility. Sometimes high profits against the investments and sometimes there are high losses. How will a person be able to organize his investments while investing in such a volatile asset class? This was the experience of the first investor. Let us see what happened to the second investor. He too invested in the same Nifty at the same prices, same days, in the same country. Nothing changed for him except the duration. He invested for 5 years instead of 1 year. See what has happened in this case. Merely by increasing the holding period to 5 years, what difference can you see? Yes, you guessed it right. Your probabilities of profits have increased a lot. There are hardly any losses except for a couple of instances. Except the holding time, nothing else has changed. And by increasing it from 1 year to 5 years, your losses are curtailed and profit instances have increased, at the same time reducing the volatility too. This means the volatility has gone down. Let's see what happens to the third investor, who remains invested for 10 years. There is no occurrence of loss in this slide. Friends, therefore can I infer by investing in equity for the long term, the probability of loss not just reduces but gets minimized and in fact completely vanishes in the long term. Look at the reduction in volatility. See 15 years here, it is even better. Look at 20 years and this picture is so delightful. There is no volatility, no occurrence of losses. Moreover, all the investors are earning similar returns irrespective of the timing of investment. There are at least a few schemes in India which have delivered similar returns over the past 20 years or so. When the investment period is longer, there is practically no difference between an intelligent and a dumb investor. No question of lucky and unlucky investor. All investors earn same type of returns. Do you know how this has happened? Let us understand the reason behind this. Friends, there is only one reason, which is called as the price discovery in the stock market. I have explained you earlier the process of price discovery. Price of the share is equal to earning multiplied by sentiment. In the short term, why are there chances of losses? How is the price discovery process in the short term? Earnings don't really change every day. Earnings change once in a quarter only. But share prices change every moment, every minute on every news update. Who is changing the share prices? Earnings is definitely not doing it because we know that earnings change only once in a quarter. So the price which changes every moment is because of the sentiment. Why do we experience so many ups and downs? Because the human tendency and human nature is full of ups and downs, highs and lows. That is why there is more volatility in the short term. Why is it not volatile in the long term over 20 years? Because you would notice that as time passes, the sentiment weakens. Friends, the biggest loss of my life was when my father passed away. Even today I recollect how sad I was on that day. I could not do anything on that tragic day. In fact, we were upset for almost 10 days. So many years have gone past. Today when I remember my father, it is with joy that I remember him and not in sorrow. Time heals the biggest losses of our lives and help us recover. Moments of grief turn into moments of joy. Human sentiments weaken with time. As time passes, the interesting observation is that earnings also grow. A company's earnings grows with the growth and development of the nation. So in the long term, price is equal to earnings multiplied by sentiment. Are you getting my point? In the long term, only earnings determine where the markets will head. Sentiment's role is almost negligible in the long term. While sentiment has no role to play, the earnings are the same for all. You remember the example of the cow which gives 10 liters of milk, and those 10 liters is constant for everyone. Since earnings are same for everyone, the returns are also same for everyone. Time in the market is important, friends. That's why they call equity as a long-term asset. If you are able to understand this little thing in investing, then you can attain nirvana or salvation in investing. You can create wealth effortlessly. That is why we call equity as one of the biggest commercial invention of the world. This is what we have to understand. As time passes, the loss curve moves towards the profit curve. Profit curve moves down and eventually both the curves converge. And everyone's profit is alike. Always remember this formula. You don't have to invest based on your sentiments. What matters in investing is the quantum of time you remain invested. I hope you found this discussion fruitful. If you are able to understand these concepts, then you can definitely become a successful investor. Participate in India's growth story and create wealth passively by investing in equity mutual funds. Thanks a lot, friends. Jai Hind. To watch more such videos, subscribe to our YouTube channel. Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.